I would like to kick off. So today the topic will be the evolution of the CLO market. We have a number of high-profile speakers at our disposal. We have Atif Kamal from TMF. Atif is a client service director at capital market in the capital market business at TMF in Luxembourg. He started his career in 2001 in the audit and financial advisory department of a Big Four, and before joining TMF in Luxembourg, he was in the Irish office in Dublin. Atif is involved in the supervision of a number of portfolio and structured finance vehicles in the CLO, CDO, CMBS, RMBS market, receivable leasings. He's seen it all. He is very knowledgeable in this product, and I'm very happy for Atif to be here. We have Ariane Mehrshahi Marks from Hogan Lovells. Thank you very much for joining. Ariane is counsel at Hogan Lovells, and she has been a key member of the founding team of Hogan Lovells when it started. Ariane is heading the banking and financing team, and we surely can benefit from her international professional experience. She is trilingual, and her specialization, as I said, is in the banking and the capital markets area. Ariane, we're looking forward to your insight. Then we have, last but not least, Isabelle Richardin. Isabelle is a partner at PwC in Luxembourg and is specialized on VAT. She assists operators in the financial industry with her indirect taxation strategy to help them to comply with indirect tax obligations and to mitigate the overall indirect tax burden in Luxembourg and international levels. She's obviously well embedded in the PwC network and is well positioned to help the clients on the international level. She has been with PwC for quite a while. I will not mention a number of years, but just to mention that she has been in the New York office at some stage and is also involved in the UK business. As much for the introduction. Again, thank you very much for all the panelists for attending and sharing their knowledge today. Why do we do this session? Now, Luxembourg is a very well-established player in the UCITS world. We all know that. It's a significant player in the alternatives world, and one segment that is growing very, very fast over the last few years is the debt fund strategy. Now, the debt fund strategy, whilst it is maybe similar to the CLO strategy, is definitely complementary to what we're trying to achieve today. And we wanted to see if the CLO capabilities in Luxembourg are a real option at a disposal in the market. CLOs have been very popular at some time before the crisis. With the crisis, the popularity has been shrinking quite a bit. A number of the investors, essentially financial institutions, have been stopping investing in these products. But today we see a new attraction for CLOs as a significantly growing asset class. Luxembourg is one of the largest capital market players in Europe, number one and number two, depending on how you count. And we see a number of CLOs, but we expect to see more CLOs in the future. And today, I think we want to talk about what these CLOs are about and why we believe that there is a real opportunity for Luxembourg in this segment. With that, I would like to get my first question to Atif. Atif, you've been working in this area for many, many years. Can you tell us a little bit about the governance structure around the CLO? What makes these structures so particular, comparing them to other strategies that we may have seen in the last few years? And to do that, I will share with you a screen, which hopefully shows you a typical capital market structure as you would see it these days.
Thanks, Rolf. Thanks, first of all, for inviting me on this panel, and then Luxembourg CNA for arranging this webinar. Obviously, it is important to note that Luxembourg, with one reason or another, couldn't see the CLO 2.0 as we call it. We were part of the CLO 1.0 before the crisis, but 2.0, maybe we will see 3.0 very soon after pandemic. So looking forward to that. As we all know, CLOs are collateralized loan obligations. This is a specific asset class which is very much helpful in raising the capital markets in terms of its credibility and in terms of its importance to any economy. I mean, we know that the portfolio could consist of senior loans, secured bonds, and high-yield bonds managed by collateral administrator. Now, it is important why I use manage, because later in the discussion, I think we have some news from Ariane, my co-panelist, about the word manage and how Luxembourg is positioning itself, which would be interesting to know from her. But getting back into the corporate governance and the governance structure of CLOs, it is needless to say that your directorship responsibility is driven by the common law. It is crucial because that's the key thing where you derive your responsibilities as director and how to deal with any company. But going specific to the CLOs, I think the key thing here is that CLOs, due to its very nature of multiple and number of investments you have in your portfolio, the quantity is slightly bigger in terms of number of assets you're looking at. So it is it's because of the dynamic nature of it as well, because the collateral administrator looks for the best possible opportunities and they invest in the parameters that is defined. So it is a little dynamic portfolio. I would say, compared to other asset classes, compared to one originator, one receivable structure, if I may. Here you're dealing with multiple investments, but the dynamics of this is there's much more order to it. So by the word order, I say, is as a director, you're sitting at a driving seat as a captain of the ship, and there are certain monthly reports which you receive which are very helpful in monitoring of your portfolio, analyzing the performance of the portfolio, and you can also predict. And that's important that as a director, you need to understand what all these ratios are saying to you, because, okay, it's important that you receive these different reports and ratios, but it is also important that as a director, you can anticipate where we are heading in terms of the portfolio, because the portfolio is dynamic, it's not static. So you have to be in a position where you can analyze, and then you can kind of predict which direction it is going. What are these ratios? That is also important to know. Without going into the further much more details of it, in a CLO, you at the very beginning define a parameter for your collateral administrator that these are the rules of the game. You can play in these rules. For example, industry concentration risk, you can define you cannot have more than 10% of your portfolio in certain industry. You can have a certain profile of AAA rating bonds only. These kind of things you define at the beginning. And then each month you are given a report that whether there are any breaches for those covenants and parameters. These parameters are also important for the note holders because they want to ensure that the rules and limitations are respected. So as a director, when you receive these reports, you look at it, and we live in a very dynamic world, so there are bound to be some ratios which could be not fulfilling and not in compliance with what is required here. So in that case, as a director, your responsibility comes in to ensure that what steps are being taken to remediate that, because it is good to be sitting on the driving seat, but it comes with the added responsibility that somebody reports to you something is not right, and then you ask the questions from the collateral administrator, what exactly are the different steps they will take to remediate that. So as a director, you have this added responsibility of jumping onto the situation and try to understand this, because there could be different tests. Some of the key tests are portfolio profile test, interest coverage test, and weighted average spread. These are technical terms. We know. But I think it's on the overall basis, you can appreciate the complexity of it, and also trying to understand what could it have an impact on your portfolio. For example, interest coverage test. It gives you a predictor. It gives you an indication whether you have sufficient interest coming into the deal to pay the interest of the note holders. Why it is important? Because then you have to look at the some of the aspects of, if in case the note holders are not being paid on time, could that trigger an event of default? Could that lead to some kind of a corporate action you need to take? So these covenants, parameters are important while sitting on the board of the CLO, because you are expected to take some action in case there is a requirement as per the deal documentation. So these ratios and everything, and predicting the liquidity are the key aspects of a CLO, because in some cases, the equity note holders have the right to call or refinance or reprice the CLO if they are not paid well enough. We will see that because of the tranches of CLOs, the subordinate tranche is also a very powerful tranche, although it's the major risk reward taker, but sometimes they have some powers which are important to look at. So overall, you can say the corporate governance is not materially different, but because of its specific nature of assets and portfolio, you have to keep in mind that when these things are reported to you, you are aware what are the implications, what could be the challenging part, and try to get the evaluation of these on more regular basis, because it also gives you an indication of possible defaults. So overall, this is how, as a director, you are the captain of the ship, but at the moment you're also looking at the tools available to you to use them at the best of those entities. So from my perspective, based on my experience, I would say what I have learned that you also look at the nature of these investments and where the strategy of the investment manager is going, because performance of a certain sector can invite the collateral manager to invest more in it, but then you have to keep an eye that the thing is not, the ratios are not out of its compliance, and make sure that the rules are followed. So if in a nutshell, if I want to say how different it is from a normal eligibility criteria of receivables, it is not materially different. In a normal single originator, single receivable structure, you have one originator which put on the table all the receivable, and then you pick your receivables based on the eligibility criteria. Here the rule is the same, that you forward your eligibility criteria to investment manager, that you can invest only AAA bonds, certain industry, and these kind of things. So it is much more similar. There's multiple originators involved in it, but at the same time you have more, you can say, data available to you to deal with it. Finally, one important thing about these CLOs, because hedging strategy is also important in this, because you invest in multiple assets. That could be any currency, any interest rate. So the investment manager is also entrusted to ensure that these risks are covered. For example, in my past experience, I've seen that some of the investment manager would enter into derivative contracts to hedge the currencies, and some CLOs have self-hedging strategy, in which case that notes are issued in the same currency as they are making the asset investment. So you could have multiple notes, currency notes, US dollar, euros, GBP, and they are investing in those assets. And then again, the challenge comes in: who you need to ensure, or the collateral manager needs to ensure, that the balance between the notes issued in that currency equals to the assets. So these are a little bit of the specificities of CLOs, which I'm sure we can discuss further, but this is where I see the corporate governance are.
Well, thank you very much, Atif. It's obviously a fascinating topic. As you said, we have seen the CLO 1.0 many years back, and it wasn't so active after the financial crisis. But it's important to point out that there are a number of bespoke consequences by being involved in a CLO transaction. You mentioned the director responsibilities, the reports, being more active in the driving seat, and probably having a few more parties involved than you would typically see in a transaction. Ariane, if I may lead to you, Atif touched about the securitization law very briefly. We touched a little bit about the usual tranching in CLOs. How does it fit into the Luxembourg securitization law and the wider legal framework?
Yeah. So the legal framework for securitization in Luxembourg, applicable in Luxembourg, currently is composed of two legislative pieces to be complete. One is the European Securitization Regulation, which came into force January last year, really. And that's an interesting part, the Luxembourg Securitization Law, which has a quite famous and favorable toolbox for us. And at the end, with some exciting news to share about a potential change and update of that law, which will indeed affect CLOs. So the first piece of legislation, just as a summary, is the European Securitization Regulation, which, if a transaction, a CLO transaction, falls into the scope, would apply, whereas the Luxembourg Securitization Law is actually a toolbox which you can opt in by choosing a Luxembourg securitization vehicle which is subject to that law. So what is a securitization under the regulation? It's typically what a CLO would look like. So it's a transaction whereby credit risk associated to a pool exposures is tranched with the characteristics that the payments in the transaction depend on the performance or the underlying pool, and that the subordination of the tranches determines the actual distribution of the losses. So that's typically a CLO could fall into it. And the consequences or the items which would be relevant then for CLOs in the context of the regulations are three to mention here. Is first of all a risk retention requirement. That is the so-called obligation to keep the skin in the game for the originator, sponsors, or the original lenders, which basically have to retain 5% of the net economic interest in the deal during the whole lifetime of the transaction. So that's often done by the originator keeping the most senior tranche, or also by having a retention on the exposure level. Then secondly, there's transparency obligations of the issuing vehicle itself, the originator and the sponsors. They have to provide investors with quite detailed information so that investors can make a completely independent assessment. That would also include, for example, quarterly reports of the underlying exposures. And in parallel to that, also an obligation to provide the same obligations to the competent authorities in each relevant jurisdictions, meaning from the SPV, the sponsor, and the originator. And the third item maybe to mention in this context is a due diligence obligation of the institutional investors, which need to basically show that they know what kind of a securitization position they invest in, That includes that they have to perform stress tests, that they have to analyze the exposure, the waterfall trigger events, defaults, etc. In addition to that, it would also mean that institutional investors have an obligation to verify whether the pre-mentioned transparency obligations and also the pre-mentioned risk retention requirements have been complied with. So that's, let's say, the framework of the EU regulation relevant for CLOs. This regulation is obviously applicable in all European jurisdictions, not only Luxembourg. Directly applicable, and it's already applicable in existing CLOs outside of Luxembourg. And the second framework, and that's the more interesting for Luxembourg and a potential attraction for the CLOs to come to Luxembourg, is the Luxembourg securitization law, which dates back to March 2004. So as I mentioned earlier, the securitization law is not mandatory in the sense, or put differently, one can use a structure and do a securitization within the scope of that law by using a securitization vehicle which is subject or made subject to the law, or one can also proceed to a securitization outside of the scope of the law, but in the latter obviously not benefiting from a quite favorable regime. So what are the features which are interesting in the framework of the Luxembourg securitization law is a toolbox which ensures or enhances the insolvency remoteness of the issuing entity. That's done with various features. One is the explicit recognition of non-petition clauses, explicit recognition of the waterfalls and the subordination clauses, so making those contractual agreements less subject to any potential challenges. Then the law has an explicit limited recourse which applies by operation of law. So technically one would not need to have contractual limited recourse clauses in the transaction documentation, but by mere application of the law, the recourse of investors and creditors would be limited to the assets of the company. And then I think that's the key feature which attracts and has made Luxembourg attractive and successful in securitization transactions is the option to use compartments. Compartments are, I always think of my moving boxes in the room. They're fully segregated estates within the same issuing entity, which means you can use the one single issuing entity for a multitude of securitization transactions. And there's a complete separation of the compartments, and the recourse of the creditors and investors into one compartment is really limited to that compartment. So in addition to this toolbox, there's obviously also a favorable tax regime with no withholding, the interest payments are tax deductible, the VAT situation is better. And all this has led to Luxembourg being quite a successful, offering quite a successful framework, attracting a lot of securitization to Luxembourg. So now this, in the context of CLOs, there's, however, a situation where the securitization law does not allow for the active management by the SPV of its own assets, which is a key feature of CLOs. So especially where you have CLOs with a dynamic pool where the investment manager or portfolio manager has a certain discretion and can replace certain assets in case of default or during the lifetime of the transaction. The reason why the active management is not in line or not the idea in line with the purpose of the law is that if an SPV or its delegate, so also in the case where the SPV would have delegated the active management of its assets is not in line with the law, is that it would create an additional business risk and that is not the idea. That's also the current interpretation of the regulator, the CSF. And therefore, and that's the good news, the ministry is currently considering to update the Luxembourg securitization law to implement an explicit or to allow explicitly the active management of assets by the SPC. And I believe that's going to really be a game changer for the Luxembourg marketplace, because it will allow CLOs, typical CLOs, to come back and use the quite favorable framework of the securitization law with the tax regime, with the insolvency protection, and so forth. So the draft bill is not out yet. It's in preparation, and I know that from the members of the Luxembourg Securitization Capital Markets Association, there will be certainly a webinar once the draft bill is out with all the details. But concerning this aspect, the idea which is currently proposed is to allow active management with two limitations. Firstly, only for transactions which are financed by on a private placement basis, so excluding actually securitizations which are financed with public offerings. And the second limitation, which is less relevant for CLOs, is that the underlying assets shall only be claims or debt instruments. That entails that equity is likely to be excluded, but that's the simple reason for that is that otherwise the law could potentially open up for holding structures to be used, and that's certainly not the intention here. So that's let's say, the exciting news and a game changer. And I believe it would, or we all believe, I think that it would open the favorable securitization law regime up to CLO structures and likely make Luxembourg very attractive again for CLOs and boost the market here for them.
Thank you very much, Ariane. That is indeed a significant game changer. We would be able to make people benefit from the legal framework with, as you mentioned, limited recourse non-petition language in the law, possibility for compartments if you wanted to, with the capability of active management in the limitations that you mentioned. That is quite exciting news, and I think we've all been waiting for that news to come through. And let's hope that the ministry is positive on that proposal. One other aspect that comes across quite frequently when we look at these type of transactions, and that has created some noise in another country, the Netherlands, not to mention them, is the VAT treatment of the different services provided in this transaction. For those who are not necessarily familiar, the Dutch authorities have decided to change the VAT treatment, which is obviously quite difficult when you have an ongoing transaction, because these are unforeseen additional costs to a structure. Marie-Isabelle, how does it behave in Luxembourg? I mean, where do we stand on that point here in Luxembourg?
Hi everyone. Thank you all. Yeah, in Luxembourg, it was felt that there was quite some uncertainties around the VAT treatment of CLO vehicles, which should not be the case, to be honest with you, because the VAT position in Luxembourg is quite clear from since 2004, actually, with the Luxembourg securitization law. So to give you a little bit of background on why we speak so much about the VAT for securitization vehicles in Luxembourg, as you said, Rolf, this came back to the discussion on the market when the Dutch tax authorities took the position that the management of CLOs vehicles was not VAT exempt in the Netherlands, contrary to ruling that the Dutch tax authorities delivered a few years ago. So the Dutch tax authorities, as a result of the new case in relation to investment funds decided to say that the management of CLO vehicles was subject to that as from 1st April 2019, so with a retroactive effect to their decision. This has been very strongly challenged by law firms locally in the Netherlands, and I think they have been successful on the retroactive effect, so that will not happen, I understand. But law firms are also challenging the position that the Dutch tax authorities are taking, because basically the Dutch tax authorities are saying CLOs cannot be VAT exempt because they are not subject to a specific state supervision, which is one of the conditions for a special investment fund to benefit from a VAT exemption. So enough about the Netherlands. What we want is to have a good framework and a competitive tax and VAT framework for CLOs, transactions and securitization vehicles in Luxembourg, which we have actually, because the Luxembourg VAT legislation is very clear. There is a specific provision which says that the management of securitization vehicles under the law of 2004 is VAT exempt. So there is, this is in the law, so only that can only be changed by the legislator. So we are not ruling like it was the case in the Netherlands. Luxembourg is not the only country to have this VAT exemption for this type of vehicles in local legislation. Large markets like our main competitor Ireland, but also France, have similar provisions in their VAT legislation. So we are not the only ones, and this is basically allowed under EU VAT legislation. So very clear VAT legislation in Luxembourg. What is a little bit less clear is the scope of the VAT exemption. So the main question is what is the treatment of the asset management or portfolio management of a securitization vehicle in Luxembourg. Here, it is also very clear on the market that the portfolio management, also servicer, servicing fees, are VAT exempt in Luxembourg. This was sometimes a little bit felt uncertain, because I understand law firms or lawyers are asked to give legal opinion on this, and because there is no written guidance in Luxembourg from the Luxembourg VAT authority, basically, this was felt a little bit not too clear, and this is why at some point earlier this year, the Luxembourg CMA decided to put together a VAT working group to work on this together. So in this VAT working group, which is composed of law firms, Big Fours and service providers, we have had discussions to already agree if there was a common alignment on the Luxembourg market, and to see whether there was any action that was required towards the Ministry of Finance, towards the Luxembourg VAT authority. The conclusion was that this was not needed, because, as I said, we have a very clear VAT legislation and also an agreement on the market of what is VAT exempt and what is not. So the result of the VAT working group has been the draft of a position letter, which will be made available soon through the LUXEMBOU publication to the LUXEMBOU member. So in this position letter, basically, we remind that we have this legislation, that the scope of the VAT exemption covers the management, the portfolio management of securitization vehicles, but not only. Because when we apply this VAT exemption to investment funds in general, what is VAT exempt is the portfolio management, but also the administrative management. So what is administrative management? We may think of corporate services like domiciliation, accounting, some type of reporting, this is also treated as VAT exempt. What is also generally treated as VAT exempt is the calculation agent services, paying agents, custodian. All these services generally are to fall under the concept of administrative management or other financial services that are VAT exempt. What examples of services that cannot benefit from the VAT exemption are, for instance, rating agencies. The rating agency services are treated generally as subject to VAT. So that means that if a Luxembourg securitization vehicle receives services from a rating agency which is outside Luxembourg, the securitization vehicle will have to reverse charge the VAT. So it means that the securitization vehicle will need to self-charge, self-assess the VAT on the receipt of the rating agency services by reporting the transaction into a Luxembourg VAT account. So this means that will trigger a VAT registration obligation for the securitization vehicle. In preparation of this webinar, I spoke last week to my Irish colleagues because Ireland is, I understand, our main competitor in this market. And basically, because I wanted to know if there was any development as a result of the case law in Ireland. And basically, the situation in Ireland is very comparable to the Luxembourg position. So they also apply VAT on rating agency services. They also exempt portfolio management fees. We discussed also trustee fees. And there, my Irish colleagues said, as a whole, trustee services should be subject to VAT in Ireland. So very comparable VAT treatment between Luxembourg and Ireland. So we can really compete. And also, Luxembourg has the lowest standard VAT rate in the EU with 17%, which is good for the small costs generally that you have to pay that are subject to VAT. One last point maybe for securitization vehicles, and because also Brexit is coming at the end of this year, and the transition period is coming to an end, and that might have an impact on the VAT position of some of the securitization vehicles, because a securitization vehicle which has a portfolio of debt in the EU but also outside the EU is entitled to recover input VAT on cost based on the proportion of the non-EU assets it has in its portfolio. So in Luxembourg, to compute the portion of recoverable VAT, we would normally use the income arising from the debt that we have in the portfolio. So from next year, for instance, UK debt, interest income from UK debt, that will allow input VAT recovery. So that will increase the portion of recoverable input VAT that we have. In Ireland, we use assets to compute the portion of EU non-EU assets because they always use net asset value. In Luxembourg, we also based on the legislation, we use impact to calculate the recovery. So basically, again, very comparable position, and so Luxembourg should be equipped to attract businesses from the Netherlands, for instance, and so on the news. And so we have this position paper coming that will be published very shortly.
Well, thank you very much, Marie-Isabelle. That's very useful information. So I take away that we have absolutely the knowledge in the market. We have hopefully soon the required legal framework allowing for CLOs to be managed actively. We have a very attractive VAT treatment similar to other countries with a slightly lower VAT rate. I do note the complexity on VAT topics in general terms, in terms of reverse charge and recoverability. So certainly a good tax advisor is important in these type of structures. So I think we're well positioned in Europe to cater with these type of structures. We do see an increased amount of CLOs coming to the market, so not only targeting the Dutch structures that may be transferred to Luxembourg or Ireland. So we have a real opportunity here. One last point in terms of competitiveness to be mentioned is that if you were to do a CLO in Ireland, you have to apply IFRS accounting, which is adding quite a significant portion of cost to the accounting and the audit process. In Luxembourg, of course, you can use fair market valuation under LuxGap, which is far more efficient when it comes to cost of the exercise. So all in all, I think we are, ready to welcome more CLOs in the market. And I would like to point out as well that LuxCMA has undertaken a great level of effort across its different working groups to try to find a common view in the market on different positions, which is setting us aside from other countries where the industry is not as much aligned as it is in Luxembourg. And the feedback I certainly receive from my customers is that this is way welcome in an environment where we have never-ending changes to regulations and never-ending questions. Having a marketplace that is sticking together and finding common answers is definitely highly appreciated. Well, that brings this presentation to an end. Before we move to the questions, somewhat more housekeeping matter to mention that next week's webinar is unfortunately postponed to the 16th of December. So no webinar next week. The following week, we will have a webinar with yet another quite prestigious panel, and the topic will be which market infrastructures towards an efficient CMU 2.0. So please reserve the time for this very interesting topic. And now I would like to open the floor to questions. Unfortunately, I can't see them on my screen, so my esteemed co-panelists will have to help me out if they can see any questions.
I did not see any.
No questions. So either everybody is falling asleep or we've been doing a brilliant overview of the topic, which doesn't leave any room for questions. I doubt both. Okay, if there are no questions, obviously you can reach out to each of us either collectively or individually. If you have more questions, as mentioned at the beginning, this session is recorded. So if you want to re-listen to it and raise your questions, please feel free either via LuxCMA or directly to us, whatever you prefer. I see a comment from François. Thank you very much indeed for your comment. Very good. Well then, let me close the presentation and wish you all a very lovely day.